In the spring of 2006, a construction worker in Florida refinanced his home for the third time. The bank told him what everyone believed: prices only go up. 18 months later, he owed more than the house was worth, and the bank that lent him the money no longer existed. In November 2021, a college student turned $2,000 into $40,000 on a coin he couldn't even explain. He told himself he'd sell at $1 million. By the next summer, it was worth less than his lunch. 2 different decades, 2 different assets, one made of concrete, one made of code. But if you put their price charts side by side and erase the labels, you cannot tell them apart. Because every bubble in history, tulips, railways, dot-coms, houses, crypto, is built from the exact same blueprint. And right before each one collapsed, the market left the same fingerprint on the chart. Almost nobody noticed it. The few who did walked away rich. History doesn't repeat itself, but it rhymes. Welcome to Hidden Patterns. Here is the story we're always told: that each crash was a freak accident, a black swan, something nobody could have seen coming. In 1637, Dutch traders paid the price of a canal house for a single tulip bulb. They weren't fools. They were the richest, most sophisticated market on earth, and they were certain the price was real because the price kept going up. In 1929, America had just invented the modern economy. A respected economist declared that stocks had reached a permanently high plateau. Shoeshine boys were giving stock tips. Everyone agreed. The old rules no longer applied. In 1999, it was the internet. Companies with no revenue, sometimes no product, were worth billions because we were told this was a new economy. Profit was an old world idea. Eyeballs were the new currency. In 2006, it was housing. The one asset that, we were assured, had never fallen in price across the entire country at once. You couldn't lose. Real estate was safe. So people bought 2 homes, 3 homes with money they didn't have. And in 2021, it was crypto. The money printer was running hot. Diamond hands. This is the future of finance. A coin named after a dog was worth more than Ford. Look at the pattern in the stories themselves. Every single time, the same 3 sentences appear. This time is different. The experts approve, and the price proves it's real. That last one is the lie at the center of every bubble. We believe that if the price is going up, something must be worth it. That rising price is proof of value. It feels like common sense. It is the most expensive mistake in financial history. But here's what almost no one was looking at. Because while the crowd was watching the price climb, the chart was already screaming a warning, quietly, in a language most people never learn to read. And once you see it, you can't unsee it. Almost a century ago, a market operator named Richard Wyckoff noticed that big money and small money behave differently, and that the difference shows up in one place: the relationship between price and volume. Volume is participation. It's how many people are actually willing to act. And at the top of every bubble, the price and the participation quietly split apart. Wyckoff called this phase distribution, the moment the smart money stops buying and starts handing its bags to the euphoric crowd. It leaves 2 fingerprints. Watch for them. The first, the market makes a high, pulls back, then pushes to a second high, just as high as the first, but the volume doesn't come with it. 2 matching peaks. Fading conviction. The price says strength. The volume says no one new is left to buy. The second is even quieter. Price keeps grinding to new highs, while volume bleeds lower with every step. Rising price, falling demand. The engine is still moving, but the fuel gauge is dropping. Now look at 2006 housing through that lens. Home prices were still ticking up into 2006, but the actual number of sales had already rolled over a year earlier. Inventory was piling up, fewer and fewer real buyers, holding up higher and higher prices. That is distribution, written in brick. And 2021 crypto, Bitcoin printed its all-time high in November, a textbook second peak. But underneath, real participation was thinning. Fewer new wallets, big holders quietly sending coins to exchanges, the on-chain signature of someone preparing to sell. New high in price, falling demand beneath it, same fingerprint, concrete or code. It doesn't matter. If you're starting to see why these charts rhyme, do me one favor, subscribe. Every video here decodes one hidden pattern that the market hopes you never learn. Because understanding the fingerprint is only half of it. The real question is, who's leaving it and why? Here's the uncomfortable part. Distribution isn't random. It isn't bad luck. It's incentive. Every bubble runs on fuel, and the fuel is almost always borrowed or printed. In 2008, the fuel was subprime credit, banks manufacturing mortgages for people who could never repay, then selling that risk to someone else. The demand wasn't real. It was rented from the future with debt. In 2021, the fuel was different, but the physics were identical. After the pandemic, central banks flooded the system with the largest wave of cheap money in modern history. That liquidity had to go somewhere, and it inflated everything from meme stocks to dog coins. And here's the pattern within the pattern. The people closest to the fuel know when it's about to stop. They see the rate hikes coming. They feel the credit tightening, so they begin to sell, calmly, in size, into the crowd's euphoria. That's the distribution. That's the second peak on declining volume. It isn't a conspiracy in a dark room. It's just that those who understand the fuel exit first, and they sell to the people who believe the price is proof. Then the fuel stops, credit freezes, the printer turns off, and with nothing left holding it up, the price doesn't drift down. It falls through the floor it never really had. The crowd calls it a crash. The pattern reader calls it the markdown. It was scheduled the moment the volume started to lie. So no, these weren't freak accidents. Tulips, 1929, dot-coms, houses, crypto, different fuel, same fire. A mania built on borrowed demand. A top where price and participation split apart, and a smart money exit disguised as just one more good day. This isn't about predicting the next crash to the weak. Nobody can. It's about literacy. Learning to read the fingerprint so you're not the last one holding the belief that the price is proof. So the next time you hear those three sentences, this time is different. The experts approve. The price proves it's real. Don't ask whether the price is high. Ask a quieter question. Is the volume still confirming it? Or has the crowd already run out while the chart keeps smiling? Because somewhere right now, in some asset, that split is forming again. It always is. Where do you see it? Drop the asset you think is in distribution right now in the comments. And tell me what the volume is doing. Let's read the fingerprint together. If this changed how you see a price chart, you'll want what's next. We're decoding the patterns the market hides in plain sight. History doesn't repeat, but it rhymes. I'll see you in the next one.